Earlier today, I sat down with Jennifer Sotelo of DST's 1031 Investments, and we discussed some of the misconceptions around DSTs. What are some of the biggest myths or misconceptions investors have about DSTs?
I think one myth is that DSTs offer a low return. So typically you're looking at between a 4 to 6% return. That is not including the deferred tax that you're doing through the 1031 exchange process. That also doesn't include any appreciation that you're getting on the back end at the end when they sell the investment.
Okay. Any other kind of myths or misconceptions that people have about it? If it's for something we hear, oh, that's for old people, or people that are getting ready to retire, from that end. Is that something that you kind of see? I know we talk about, it's for a wide range of investors. So,
Yeah.
it's one of the things we always hear or see about that.
Yeah, that's a great point. There's a lot of different strategies to using DSTs. So it can be for an older investor who may no longer want the responsibilities of managing and owning real estate. But it can also be for the type of investor who wants to use DSTs as a backup to their physical like-kind property, right? They may be a younger investor who still wants to manage real estate. However, they still want to defer the capital gains tax. So they use DSTs as a backup in case their first option falls through. So there's a lot of different strategies and ways to invest in DSTs. And that's why it's helpful to talk with a DST broker like myself. They can walk you through all of your strategies to make sure that you understand all of your options.
Okay. Yeah. So do investors lose control over that investment when they invest into a DST? So how does that kind of?
Yeah. So I guess, losing control, it can be a double-edged sword being in a passive investment, but that's what a passive investment is, right? When somebody no longer wants to have control or wants to have any managerial responsibility, they will invest in a passive investment. So it's one of the benefits of being in a DST that you're in a passive investment. But if you're not accustomed to having somebody else manage your real estate, you may feel like you've lost some sense of control.
Okay. No, I see that. And then, one thing we kind of always hear, oh, the DST is for a wealthy investor. Is that true? What is it? Who's a DST, really for? Again, that's one of the things we always hear.
Sure. Yeah, definitely. It's really for anyone who is an accredited investor, is looking to defer capital gains tax through the 1031 exchange. So we have people with very modest real estate portfolios in 1031 exchanges investing in DSTs, all the way to family offices who may be looking to defer a larger amount of capital gains tax.
Okay. And then, so is it true that once you invest into a DST, you can't sell that investment or exit early, correct? Is that how that works?
Right. Typically, DSTs are an illiquid investment. So there really is no secondary market for your investment. So you're in the investment for 5 to 7 years. And we could find an investor to possibly step into your investment, but we don't recommend that as an exit strategy.
Could it sell prior to that 5 to 7 year mark? Do you see DST selling sooner than that sometime, from that end?
There are some unique investment strategies where you can defer capital gains tax and it's less than 5 years. Typically, it's 5 to 7 years is that mark. And you can 1031 exchange right after that into another investment.
Okay. So you can see, so really that's one of the big things people need to be aware of is that, hey, I'm going to invest into this DST. I'm pretty much in this contract for 5 to 7 years with no control over when I want to sell it or so forth like that.
Yeah, I mean, there's some benefits to being in an investment for 5 to 7 years too, right? I mean, the investment will generate appreciation after 5 to 7 years, which the investor gets to benefit from that appreciation.
Okay.
So
awesome. Yeah. So how does, people, when you bring a DST, from what we see, they've never heard of it, and they're like, oh, is that a REIT? What's the difference between the DST and the REIT?
I get that a lot, actually. So there are some major differences. One, a REIT, you have a share of a public interest in a property. So it's structured differently. In a DST, you have beneficial ownership. So you have tax benefits. DSTs also qualify for a 1031 exchange, which REITs do not.
Right.
I think the major confusion is that both DSTs and REITs invest in high quality institutional grade property, so people see them very similarly.
And I think it's part of it is, like you mentioned, with the REIT, you have control over when you want to sell, as opposed to the DST, where it's then up to that trustee or that sponsor who has that control on when it's time to sell.
Yeah, that's a great point too. Yes.
Awesome. So, it's one of the things everyone comes up. Sometimes it's when you're trying to explain to them, it's it's like a REIT, but it's not a REIT. From that standpoint, and then you go into explaining a little bit how it satisfies from a 1031 perspective that like kind property there. One thing we hear is, do DSTs, is it just with one property, or is it like, am I investing into a portfolio that has multiple properties? We get a lot of those questions as well.
So it really ranges. You're investing in an institutional grade property. That's the same throughout. There are some DSTs that will specialize in one asset class, like multifamily or self-storage, for instance, which is excellent because that's what the investment firm specializes in. That's what their expertise is. There's also DSTs where there's a portfolio of triple nets, so it's the same asset class. You're just investing in multiple different types of triple net properties, which is also great for diversification.
Okay, awesome. And like with any investment, there's obviously those benefits that come with the DST. So what are some of the biggest risks associated with the DST? What are those misconceptions that are out there about the risk associated with it?
So it really depends on the investor, really what your risk tolerance is. So the biggest risk, I think, is it's an illiquid investment. So you're in the investment for 5 to 7 years. Another one that comes up is that it's a passive investment, so you don't have day-to-day management or decision making in the investment. So people may feel like they're losing control. And then there's also market fluctuations, right? So like any type of real estate investment, things may happen in the market that may increase or decrease income. So,
are there any misconceptions that you hear about, oh, what's the financing aspect of it? Because I think a lot of people are like, oh, I have to replace the value of this debt on the property I sold. Obviously, a DST is a great way to replace that debt by taking on leveraging, how the DST leverages some debt on that side. So is there any risk to me with that debt that is out there?
Right. So it's when you're investing in a DST, it's non-recourse debt, meaning there's no responsibility or liability on the investor for that debt.
Okay. No, that's great that people then kind of realize that I might be getting this DST that has some debt that's leveraged, with some debt for the purchase side of it. But that I'm not fully liable then for that debt, which is what I think a lot of people can see with that. So from a DST standpoint too, one of the things that come up with 1031 is the same taxpayer rule, continuity of taxpayer. Can I buy that DST as an LLC from my LLC, or am I strictly having to buy it as an individual into that
That's
DST portfolio?
Great question. So when it mirrors, so to speak, whatever investment that you're coming out of in your 1031 exchange. So if you're selling your property in an LLC during your 1031 exchange, you'll reinvest as an LLC into the DST.
Okay. So it's not just me individually as a accredited investor. it then looks at, I can invest if it's my LLC or my corporation and so forth on that. I'm allowed to invest in that, so I'm not restricted from that.
Exactly.
Okay. No, that's great. And then, so are DSTs recession resistant? How can that play into the market, as it changes around from that end?
It can be, depending on the investment. Like any sort of real estate investment, different asset classes do better during certain times of the economy, right? So an Amazon distribution center, for instance, did really well during COVID, right? That was a great example of an institutional grade property that was recession resistant during that time. So it really just depends on the asset class.
Okay. So are there any limitations that a DST might have that make them honestly a poor fit for an investor?
So poor fit for an investor, it's probably not a great fit for anyone who's looking to be in an investment for less than 5 to 7 years.
Okay.
And then also someone who's not ready to be in a passive investment, who still wants
control over being able to make decisions and so forth that come along with that. No, so awesome. And with that, and so what about the illiquidity with the DST? Is there, how liquid or illiquid is being able to go with that DST?
So they're typically illiquid investments. You're in the investment for 5 to 7 years, and there really is no secondary market. So we can possibly find an investor to take over your place, but we don't recommend that as an exit strategy.
Okay, awesome. And then, so what should an investor know? Like, obviously, with any investment, they want to do their due diligence, right? So what would you say to an investor as far as, what they should perform, whether selecting a DST or looking at the sponsor of that DST, or that investment as a whole? So how does that
One
play
way
out?
is to work with a knowledgeable DST broker like myself. So, our DST 1031 Investments has been in the space for over 25 years. We've done all due diligence on all of the DSTs that come through. So we're knowledgeable of the sponsors that are in the space. We know the individual. There's 90 different DSTs in the market at any time. So we're familiar with those. I personally will go and visit a lot of these properties. I was just at a self-storage facility last week. I visited a hospitality investment 2 weeks ago. So we spend a lot of time getting to know the sponsors, getting to know the investment. The investor themselves can also look at the private placement memorandum. So it's a legal document that's put out by the sponsor that outlines every aspect of the investment.
Okay, so the way what I'm understanding is obviously the sponsor does their due diligence first and foremost. Then you might come in and say, whether it's doing the due diligence on the sponsor, but also the investment that sponsor has as well, from that end. And then so the investor now looks at all these, whether it's the PPM, looking at the details on the sponsor, the investment, and obviously with you going out there, is that investor able to go out and look at the property? Is that part of their due diligence, if they want to?
We do that a lot too. Yeah, definitely. The investors are welcome to come and look at the properties themselves. We do meetings with the sponsors directly as well. So the investor and the sponsor are in the same meeting. So we do anything so that the investor can feel comfortable and knowledgeable about the investment.
Okay. And then so across states, so how does the DST play in? Is it multiple properties in just one state? Can it expand across states, from that end? How does that look in? And what, as an investor, should I be aware of, especially if it's going across states?
Yeah, so across states, yeah, there are DSTs all over the country, from California to the East Coast. There are tax implications with investing in certain states, so you have to be knowledgeable of that. A lot of DSTs are in certain areas that maybe are no state income tax, or there's certain DSTs in certain parts of the country that,
So do people come to you saying, hey, I want to avoid one of these higher tax states. Do you have any DSTs that are strictly in no state income tax, places or something like that?
Yeah,
Is that part of their process when trying to evaluate what they want to do, or your process with them to understand what do they want to do from an investment standpoint?
Most definitely. So we will sit down with the investor and we will talk about what their investment goals are and then create a strategy around all of that. So it can also include, you're coming out of a 1031 exchange. What is your debt to equity ratio, right? So we have to look at all of that. And then we will create a strategy with possibly multiple DSTs, if that makes sense for you. And present that strategy, and we go back and forth and we discuss that.
No, this is all great information. Truly appreciate taking the time to kind of explain a little bit more about the DST, those misconceptions that are out there, some of the benefits, and obviously with any investment, the drawbacks that come with that. So we do appreciate your time coming out, and sitting with us and having this conversation so we can educate people more on what the DST is, how it could be a great tool for their portfolio, whether doing a 1031, building generational wealth on that end. So I appreciate it.
Well, thank you for having me.
And that right there wraps up our conversation about DSTs. If you have any further questions about DSTs, feel free to give myself or Jennifer a call. Our contact information in the description below.